I guess it's still good morning. How's everyone doing so far? Some good content? Are we good on this here? All right. So we're about to have our panel discussion here based on the exchanges, the innovation and infrastructure to basically keep up with all the innovation that we've heard about already and we hear about the rest of the day. The first thing I just want to start off with is introducing myself. I'm Steve Capurso. I'm at Old Mission Markets. We are an ETF market maker, a lead market maker in DLP. We support products on both exchanges, LMM for SIBO and DLP for NASDAQ, as well as NYSE Arca. We have about 250 products right now that we are the market maker for. Half of those are derivatives based, so the last topic of this, and obviously levered products also. But I just want to first have my two panelists here, Victor from SIBO and Gabrielle from NASDAQ, introduce themselves, and we'll start from there. Gabrielle?
Yeah. Hi, everyone. I'm Gabby Vanetti. I am the Senior Manager of ETF product at NASDAQ, so that includes liquidity programs. I work very closely with issuers, regulatory items, data, all that fun stuff. And Victor, I'll let you take it.
Yeah, thanks, Gabby. Hi, everyone. I'm Victor Werney. I head up SIBO's North American exchange-traded product listings business. Today in the United States, we list over 1,100 ETFs, and we're one of the largest global exchange operators out there today.
Great. So let's just start off, jump right in it. Just kind of a little side note. I've been involved with STA for a while on the national level, and market structure is always a huge topic. And recently, over the last couple of years, the ETF industry has basically had a seat at the table with the STA, and because as I like to tell people in our business, the point of sale for an ETF is on the exchange level. So anything that happens globally overall, or even nationally with the SEC, any rules they're making and theoretically can have a direct or indirect impact on how ETFs are traded and how people experience that buy and sell. But first off, let's start off with the situation where the Texas Stock Exchange just listed recently, which is basically going to democratize the ETF industry a little bit more, to have a listing venue in Texas. NASDAQ and SIBO and NYSE Arca have all been trying to make inroads into kind of compete in that space. But just kind of like overall, just kind of briefly to go over, Gabby, kind of from the standpoint of, I know a couple of weeks ago there was an announcement about NASDAQ Texas. Can you kind of just go a little briefly into kind of what the thought process is behind that, and kind of what you guys are sensing from your customers as well as the industry, of kind of like why that's kind of happening?
Yeah, I mean, Texas continues to be a really new and exciting growth area, I think, for the country and frankly the world. If it was its own country, it would be the 8th largest economy. And so with the launch of NASDAQ Texas, we're really trying to give both corporate investors and ETFs, corporate issuers and ETF issuers, the opportunity to expand their exposure, expand their footprint in Texas, or to continue to remain strong. We support a number of issuers, both from the corporate listing side and from the ETF listing side in Texas, and we've been in the state for quite a long time with offices there. We actually announced a few years ago that we were building out a large regional headquarters there, so we really feel that NASDAQ Texas is kind of the next step in that. And so we are going to be repurposing one of our already existing exchanges into NASDAQ Texas, because we're also very cognizant of maybe not wanting to add another equities venue. So.
Thank you. And Victor, obviously we all know that SIBO has been centric to Chicago and the options pits for forever, with the SPX being the sole listed there in Chicago. What is SIBO's kind of plans, or kind of what is SIBO looking at from a standpoint of, is it going to be a rush to like build a location down there, or you guys are comfortable with the space you have, and how are you guys reaching out to clients in, within Texas as well as other parts of the country to kind of, basically kind of, contribute and kind of be part of the conversation?
Yeah, thanks, Steve. So to your point, here at SIBO, we operate some of the last and largest open outcry markets in the United States today. The SPX pit specifically has over 100 traders in it. 20% of SPX volume still happens on the trading floor today, which equates to about $2 trillion on a notional basis each day. In addition to the SPX pit, we also have the VIX pit, the Russell, and a few other single stocks down there. So Chicago is at the center of SIBO. We're very excited to be in Chicago. We're excited to be in that space. We also have offices in Kansas City and New York. But as it relates to Texas, it sounds like a great opportunity over there. A lot of the other exchanges are getting involved. At SIBO, we're not necessarily focused on corporate listings. We're an ETF shop. So with that, there hasn't been much conversation on our side of jumping into the Texas side of the equation quite yet.
Gotcha. Thanks, Victor. So let's just hop into the other big news today that came out is that the SEC finally gave the final approval to Dimensional for the ETF share class to offer ETF share class within 13 mutual funds. Obviously, this has been a highly anticipated development within the ETF industry, and it's kind of made the traditional ETF issuers that have kind of dominated the field for the last 20-something years. The last 5 years, I would say, there's been a lot more new entrants into the industry, especially traditional asset managers that have been kicking and screaming, their whatever side of the business has been to not launch an ETF, not cannibalize their traditional mutual fund business. But from the standpoint of ETF share class, kind of where do you see that going? Do you agree with the last panel where they had said that it's going to be more of a wait and see kind of deal? It kind of sounds like Dimensional is going to probably get out there first, and then people are going to kind of see how that develops. But kind of from your standpoint, what do you feel this is going to do?
Yeah, I think that it's going to be kind of across different issuers. We'll have different approaches. There's certainly a lot of operational items that folks need to work through when it comes to launching these. And we've heard from some issuers that maybe they don't necessarily see a big leap in being the first mover, and rather they want to be a thoughtful second strategic mover. But we've also heard from issuers that they want to be first out there. They're ready to go. They've been working on this for a long time. And I think from NASDAQ's perspective, we're ready to help the issuers and meet them kind of wherever they are. We're working very closely with the SEC, as I think the other exchanges are as well, to get our own version of the mutual fund share class filing so that it kind of mimics the 6011 launch as closely as possible. Right now, we are still able to handle mutual share class launches. They would just be under some of our older legacy rules, and we certainly want to make things as easy and simple as possible when folks are launching these.
Great.
Yeah,
Victor?
just to build on that, Gabby, so on the SIBO side, multi-share class is something we were at the forefront of. We were the first exchange out there to essentially file the process for to streamline the process for ETF asset managers to come to market in the multi-share class wrapper. So today, to Gabby's point, pending regulatory approval, we could absolutely list a multi-share class ETF. The issue with listing a multi-share class ETF under the existing rule set is that rule set is pre-6011. And pre-6011, some of the people in this room may remember, we were doing 19B4s for fixed income ETFs, defined outcome ETFs. 6011 has really streamlined the ability for asset managers to come to market in a fair and efficient manner. So with that, essentially with our filing, we're advocating with trading and markets to essentially streamline the process so that if an ETF asset manager gets approval, we could essentially list that ETF in a very similar manner to any 6011 ETF that's out there today. To Gabby's point, we're continuing to have conversations with the regulator around this. We're very optimistic and excited about this holistically, and it could really lead to a number of products coming to market. Based on Josh and Ben's comments on the last panel, I'd echo the feedback that it doesn't seem like asset managers are really racing to get to market here. There's a few different kinks that still need to be figured out and ironed out. A lot of people are paying attention to Dimensional and how Dimensional is going to approach this holistically. So we're excited to stay atop of this trend, continue to speak to the regulator, continue to speak to our clients and other industry participants to make sure that when our clients want to come to market, we're here to support you.
Great. Thanks, Victor. So along those lines, obviously the exchange is within that ecosystem of different service providers for ETFs. So one of the biggest questions that people have outside is, okay, you have different exchanges, why would I list on NASDAQ or CBOE or NYSE Arca or whatever? Like, what differentiates the three exchanges? From a lead market maker standpoint, I mean, we're mostly agnostic. So we'll basically, the issuer says this is who we're going to work with. We have relationships with Victor's team and Gabrielle's team, as well as the other exchanges teams, to kind of help support as much as we can. But from your standpoint, let's start with Victor this time. What part of the process do you guys usually jump in with prospective issuers, whether it's the existing issuers or newer entrants into the space?
Yeah, Steve, we're there day one. So what's really unique about my team is that many people rely on the listings group at CBOE as product consultants. Holistically, I've helped handle over 1,000 ETF launches out there today. My team has done over 1,000 ETF launches. We see people at all different iterations of the ETF life cycle, whether that's deciding on tickers, doing competitive analysis on what else is out there in the market, introducing people to our flex options team as derivative-based products are really coming to market quite frequently this year. Over 50% of ETF launches in 2025 have incorporated derivatives in some sort of manner. And with that, CBOE's ecosystem helps accommodate for that. So not only do we have a tremendous listings team, but we have an excellent data vantage team. And that data vantage team is providing theoretical option pricing services for issuers utilizing flex options. It's providing indexes, intraday net asset value calculations. So I'd encourage the people to speak to the exchange as early as possible, because there's so many different areas of the exchange that have product experts that could really help avoid some nuances when bringing a new ETF to market.
Yeah, and to Victor's point, I think there's really a holistic support system that comes once you start speaking with the exchange. We have experts that have launched almost every kind of ETF product at NASDAQ, from our legal team that can help you support newer innovative types of ETFs, from our listing qualifications team that can ensure that your listing day and your launch day goes really smoothly, from our data and reporting team, where we can definitely give you newer or different insights into how you're trading, what your liquidity profile looks like, and additionally from our marketing team to ensure that that brand alignment is there, that your visibility is there. They can work with your distribution, marketing, and sales team. We really do want to provide the most amount of services and help that we can, using the expertise of having launched so many products and being available to you when you need us in whatever aspect that you need us.
Great. And along those same lines, like, do you guys feel that you guys are properly staffed to kind of support this whole flux of new issuers, especially, people that have never, thought about launching their own ETF, as well as kind of all the different nuances that were discussed earlier with the operational point of how the ETF, how actually an ETF functions, create redeem process, all those things. How do you guys kind of structure your teams to kind of service those different needs that, the issuers that have been around for 20 years, they have obviously different needs than people that are started talking about listing an ETF a year ago, and now they're there now at the table because they're seeing, ETF mutual fund conversions happening. Now it's going to be ETF share class. Like, kind of what kind of teams do you have, and kind of, what is your best way that you would suggest an issuer to kind of navigate through those different teams, and kind of where would be the first point of contact?
Yeah, so from our perspective, the first point of contact is me or another member of the business team. We really will take your first intake email. We'll be with you throughout the whole process of pitching, up until launch day and up until after. We make sure from the ongoing and legacy issuer perspective that we're having regular check-ins, both with our team and our marketing team, to ensure that you're feeling supported. From the new issuer standpoint, we'll walk you through what launch looks like. And when you list with us, you do get a listing qualifications analyst right away. So they help you through that whole listing qualifications process, which we know can be a little bit daunting for first-time issuers. Additionally, we are actually staffing up because of the record number of launches. I think Victor and I both agree this has been a record year for ETFs. We're seeing, from NASDAQ's perspective, our total number of ETF launches in 2024, we actually hit and surpassed that number in 2025 in July. So it's just been a really explosive year. So from our perspective, we added a new member of our team last week to handle business development. We're adding new folks on our listing qualifications team. We're also adding another analyst. So we really are trying to staff up and make sure that we're supporting issuers wherever we can.
Great.
Yeah, thanks, Gabby. So ETFs are at the epicenter of the exchange. And with that, there's so many unique elements of the exchange and people within the organization that can weigh in on different ETFs coming to market. From the SIBO side, we are absolutely staffed up. We got ahead of that with the multi-share class announcements. On the business development side, we added 2 headcount to the team this year in 2 different regions across the United States. We added another attorney on the legal side, and we're continuing to add to our regulatory team in other areas across the organization. What's unique about the exchange, though, to Steve and Gabby's point in terms of product experts, is when you're really looking to launch complex, first-of-their-kind ETFs, there's a plethora of resources on the SIBO side to kind of hash that out with. Whether it's our legal team that's been on the cutting edge of some of the really unique product filings that you've seen out there today that require 19B4s from an exchange standpoint. SIBO was the first to launch semi-transparent ETFs in the United States. We were one of the first to file for Bitcoin ETFs in the United States. We launched the majority of spot Bitcoin and spot Ethereum ETFs out there. So complex, innovative products, that's what we do. That's what our team's built around. But with that, we also have a plethora of marketing resources, a plethora of other areas of the organization that continue to step in and provide feedback for issuers when they have questions about holistic items such as digital assets or derivative-focused initiatives.
Great, thanks, guys. So from that standpoint, I mean, obviously, as a lead market maker, we're the point of contact with the issuer once it's already the product is listed on the exchange, and there's obviously constant questions all the time about market orders, the handling of market orders, market on open, market on close. I like to say this public service announcement for the 80th time at every conference you're at. Don't buy on the open and don't buy on the close if you don't have to. Market orders, for an ETF, especially in those first 10 minutes of the trading day, most lead market makers like to make sure the underlying components of the ETF are opened up so we can have a better idea of the price discovery, what the ETF is worth, and then set our markets accordingly to that. Recently, in the last several months, just to kind of jump in there, I know both of these exchanges have come up with programs now to kind of change their market on open process for ETFs, and I like them to both kind of discuss, where it came from, kind of the complaints or kind of comments that they've happened from market makers, as well as market participants, as well as exchange officials, obviously SEC, regulators and stuff about, market on close and market on open to start off with, but then maybe market on close, and obviously the use of market orders within the trading of the ETF during the day.
Yeah, thanks, Steve. So the opening process is such a unique and important process of the trading day. So for a new ETF IPO, traditionally we would halt the IPO from 8 a.m. till 9:30 and then open up that ETF at 9:30. That's how we pretty much handled it since I joined the organization back in 2018. With that, we received tremendous amount of feedback from different ETF issuers out there that, hey, while we love being able to open up our product for trading at 9:30, for some of these more complex products that are unique, different, first-of-their-kind strategies, we want to get those out to market as early as possible. So with that, we developed functionality on our side to allow issuers to get out at 4 a.m. in the pre-market session. Today, on a go-forward basis, on our main equities book, SIBO BZX, we actually open up all our securities at 4 a.m. for trading and quoting. But what's unique about IPO day is previously where we halted, we'll now open it up as a normal way security for ETF issuers that understand the risks of pre-market activity and want to get that ETF out as early as possible. With that, we're also developing functionality on our side, pending regulatory approval, that really gives a unique manual element to an electronic exchange. So we've heard a lot of feedback from different issuers, and we've watched a number of different launches where launches will open up on a quote rather than an actual trade in the auction. Sometimes when these products open on a quote, that quote might not be as tight as the issuer expects. To Steve's point earlier, the first 10 minutes of the trading day tend to be some of the most volatile times from a spread perspective. So with this functionality that we're looking at is essentially developing a portal for market makers to go into to set prices and price bands so that when the security is within those prices and price bands, it would open up accordingly. With that, we're really excited that it's kind of a unique in a sense that it is that manual element on electronic exchange side, but we're looking forward to continuing to have those conversations, continuing to listen to asset managers, market makers, and other industry participants to roll out innovative, cutting-edge market structure enhancements that really focus on investor protection and benefiting our ETF issuers and clients.
Yeah, from our perspective, so we've actually always opened all of our ETFs until this summer at 4 a.m. so they could participate in that pre-trading because, as Victor stated, it's really important for newer and innovative product types to be able to participate and kind of be first out the door. We saw that with the Bitcoin ETF. Some of our Bitcoin ETFs did very well because they were able to participate in that pre-market where there was all of that buzz and investors just couldn't wait to get their hands on the product. But over the summer, we launched a manual process to allow issuers to treat their ETF launch day, if they opt in, as almost a mini IPO. It's the same process that we use for our corporate IPOs, where essentially we're on the line, the market maker is on the line either through Bloomberg or on a call, and we're making sure that a member of the ETF business team is also there, so that as quotes come in, you're opening at a price where the market maker agrees that everybody feels comfortable with, and then we're able to get that started at around 9:40 to 9:50. And so we've seen a lot of success with that. We've seen a lot of issuers opting in, and we're excited to see how this program continues to progress. And to your point about the close, we're actually making some improvements to our liquidity programs, and specifically with our liquidity programs, we've added in additional metrics that market makers need to hit in order to receive their rebates as part of the liquidity program around specifically the closing and opening auction, where we're requiring a layered in notional depth so that when large orders come in, you're not blowing out the whole book. You're having that depth in there and making sure that, as best as possible, we're incentivizing our market makers to ensure that trading goes smoothly.
Perfect. Thank you. So along those own lines of, investor protection and, the advent of retail trading, and both of you touched on starting trading at 4 a.m., obviously, there's been a lot of talk about 24/5 trading starting up in the U.S. and being active on exchanges, where now before that, obviously before the exchange has been more involved, other services like, Blue Ocean and some others like that were trading overnight to kind of capture some of that retail flow that's coming in from Asia into the United States, mostly in ETFs, and ironically, a lot of it in the levered ETFs and derivatives-based ETFs that that are a little bit more complicated than the traditional ETFs that have been out for a long time. So from that standpoint, what are you guys doing to kind of support that? Are you guys going to be prepared to and able to kind of provide all the protections on those overnight trading for U.S. investors if they are transacting on your venues overnight? What does that look like, and kind of, where do you see that coming? Do you see it as eventually where we have 24-hour a day trading, within the U.S., shifts of, obviously more computers with AI, you probably need less bodies overnight to do it as before, but you're obviously going to need human oversight of kind of like what's going on in those hours. So kind of what is kind of like the plans, if you're able to discuss, and kind of where do you feel the exchange can kind of be that place where investors will feel protected, regulators will be comfortable that there's no market manipulation going on overnight, and then obviously that all leads down to investors being more confident in the U.S. market.
Yeah, so what many people don't realize today is at CBOE, our SPX and VIX options trade nearly 24/5. So we have trade desks in the United States, Amsterdam, and Australia, and we actually operate under a follow the sun model. So as the sun is moving, our trade desk coverage is shifting across the globe. So operationally, we're absolutely set up to be able to support 24/5 trading today. It's something that we pride ourselves on the CBOE side and have done a lot of operational analysis around. As it relates to 24/5 from an equity standpoint, once the DTCC is ready, once the SIPs are ready, the consolidated tapes, the SEC, CBOE will be ready to go day one. It's something we're geared up for on our side, continuing to do analysis around, have the operational model in place. But once the industry holistically is ready to support that, the exchange itself will be ready to go too.
Yeah, I think 24/5 is a really exciting and new concept, but it does take a lot of operational work to get there. As Victor alluded to, the SIPs are really important. I think there's an ongoing SIP committee that's working really hard to ensure that this goes smoothly as possible, and all of the exchanges are kind of ready to go. From our perspective, we are a global firm. We have over 300 clients in Asia specifically and in APAC. And so we want to make sure that we're supporting those clients, we're supporting those investors, and they're able to trade during their trading day on the exchange if that's what they choose. And we're also wanting to support our own American investors from the retail perspective that might be trading off hours. But I also do want to note that pre-market and post-market have existed for quite a while. We've seen a lot of successes with those. We haven't seen a lot of market issues. And so we're hoping that we can continue those lessons learned from pre-market and post-market and expand on those as we add extra trading hours.
Thank you.
To Gabby's point on that, actually, Steve, so one of the biggest questions we get from ETF asset managers is, with the rise of 24/5 trading, am I going to have to add additional coverage to my capital markets teams to be able to accommodate for trading on a near 24/5 basis? And one of the points that we make in those conversations is, whether you realize it or not, many of these securities already open up at 4 a.m. today, and they're trading up until 8 o'clock at night in certain instances. So if you don't have coverage during those times already, you may not need to have coverage down the road, but it really depends on a product by product basis and where those flows are coming from. If they're coming from Japan, if they're coming from Asia, it's all important considerations to think about when expanding your team as trading hours increase holistically.
Great. Thanks, guys. So just to kind of keep it on that whole thing with investor protection, one of the biggest questions and the biggest issues that the market making community, the lead market maker and DLP community confronts is a quote unquote erroneous trade, right? So theoretically in the past, what's happened is a customer or a retail person or whatever sends a market order directly to the exchange. The liquidity providers or the LMMs and the DLPs have layers of liquidity out there, but sometimes the liquidity gets exhausted, and then you get a print up 2%, 3%, 4%, and so just from the standpoint, just to kind of refresh everyone's memory of what exactly constitutes an erroneous trade, and kind of what are the steps that the investor or hence the broker or can take to kind of get that addressed, and really in all likelihood, what percentage of those type of prints are actually taken down from the tape, and you're able to find who the buyer and the sellers are in this fragmented world we're in.
Yeah, we have a really robust trading ops and market ops team that works really closely when we do see trades come in that are very far from NAV, and we want to make sure that we're supporting issuers and market makers if there are problematic trades. And I think the other important aspect from the NASDAQ side is that not only is it market ops and trading services, but also the business team. If you call me and let me know that you're seeing something in the print that doesn't look right to you, that's far from NAV, I'm always happy to get on the phone. Members of the team are always happy to get on the phone, and we'll try and come up with a solution for you as best as possible, as best we can. And so I think it's really a matter of making sure that we're responsive, we're there for the clients, and we're continuing to surveil prices, especially on launch day, to ensure that trading is running smoothly.
Yeah, Steve, on the SIBO side, we have automated surveillance tools in place to scan for potentially erroneous or aberrant trades. In addition to these automated surveillance tools, we have a tremendous trade desk based out in Kansas City, comprised of multiple individuals that are constantly monitoring our primary listings and equity markets holistically. It's actually very rare that we see a trade get busted today, but what happens more commonly is an aberrant marking. And what an aberrant marking is, it essentially means that the trade still stands, but it's removed from the 52-week high or low of the fund. For an aberrant marking to occur, there's certain percentages that need to be hit based on the last trade price. But what's really unique about that aberrant marking is that for your sales team at the end of the day, if you're able to get an aberrant marking on a bad trade from a market data perspective, that print is removed. What's also unique about aberrant markings is that it has to happen on a lit venue. So one of the 18 equity exchanges out there today, unfortunately, if it's an off-exchange print, it's very, very rare that you would see an aberrant marking on something like that. So it's something we take a lot of pride in on the SIBO side. It's something we constantly flag for our customers when we see something like that happening. but it is really vital in the sense that it removes your sales team from having to have a conversation of why there's potentially a $30 print and a $25 security that should normally trade around $25.
Yeah, and to Victor's point, I think about the off trading versus the lit exchange venues. That is just another aspect of why it's so important sometimes to make sure that you have good liquidity on exchanges, because we are able to be that support system for you versus the aberrant marking, as Victor said, off exchange trading is just really hard to reach.
Gotcha. And then next topic, obviously what's something that's near and dear to the lead market making community, the market making community, is with the ETF share class. Right now I think there's about 4,000 ETFs that are listed in the United States right now. The share class, there's predictions of doubling that size or tripling that size at some point. Obviously I agree with the last panel that it's not going to be it's kind of like, it got approved. Dimensional is probably going to come out first, and then it'll be wait and see for all the other members of the ecosystem to kind of be able to see if they're able to support this. From a market making standpoint, I can tell you that at this point, one of the biggest things that an ETF has, and it's basically everyone in the ecosystem has done a great job of preaching the tax efficiency of the ETF, right? So theoretically, kind of the process of converting the ETF to a mutual fund to an ETF, or offering an ETF share class, is in order to get the tax efficiency of the ETF, to your end user. Basically, an ETF and a holder of an ETF will get charged a capital, will incur capital gain from the price movement of the ETF, but actually the underlying components are able to move in and out of the ETF through an in-kind process where there's no taxable event for the actual inside the trust, I guess, and it doesn't get filtered to the end user. From that standpoint, it's a very capital-intensive transaction for the market-making community. Obviously, there's a handful of maybe 5 to 10 lead market makers out there now in the U.S. right now. What is the exchange doing to enhance and make it more hospitable for lead market makers to put liquidity out there, to commit their capital, to make a fair and orderly market, and also be able to facilitate these SIB orders, custom in kind baskets that are going to be happening, because when these mutual funds, they convert over, or the ETF share class, they're going to want to start doing these transactions, and it's going to be a big capital ask to the street.
Yeah.
Yes.
Oh. Okay. All right. Thank you. So from our perspective, we're continuing to make enhancements to our liquidity programs. I alluded to it earlier. And these liquidity programs come with rebates and stipends to the market maker to ensure that we are incentivizing them to meet metrics that keep trading orderly, keep it robust, keep spreads tight, and just ensure general liquidity in the markets. And I think we also work really hard to keep up great relationships with market makers, to really hear them out, take their feedback, and then continue to improve upon that, whether that be from the liquidity standpoint with our liquidity programs or from our data and reporting. We actually offer pretty enhanced reporting systems for our market makers so that they can see how they're comparing to metrics around spread, quotes, depth, all of these really important factors when it comes to keeping trading going. And so we're not only supporting them from the incentivization side, but also from the reporting side and making sure they have all that data that they need.
Yeah, so pending regulatory review on December 1st, we are going to be rolling out a number of enhancements to our already exciting lead market making program. So today, with over 1,100 ETFs listed on our main equities book, Cboe BZX, the way in which our lead market making program operates is we actually group all of those 1,100 securities into two different asset classes, U.S. equity and other. The reasoning behind that is because it's much more straightforward for someone to quote or hedge a U.S. equity product than it is maybe for them to quote and hedge a Bitcoin product. So with that, as more and more innovative products have come to market, speaking with the asset management community and speaking with the market making community, we want to expand the different asset classes that we're putting quoting requirements in front of. So in addition to US equity in that other bucket, which is a generic catch-all for everything not US equity, We're going to have requirements based on funds that are holding international equities, fixed income, outcome-based products, so the defined outcome universe, leverage and inverse strategies. So we really want to make sure that the capital that Steve and his team are putting up and the spreads that they're making are in line with what they would want to do based on the asset class they're quoting to at the end of the day. So that program is really exciting. We have base level requirements and enhanced level requirements to really incentivize top tier market quality. But it's a continual conversation that we're constantly having with the lead market making community, asset managers, and other industry participants, because market quality is at the forefront of a lot of end investors' minds.
Great. And then along those lines, obviously, Hector and his panel this morning were talking about in Europe, there's obviously a direct payment system in place for paying market makers directly. In the U.S., I believe the statute is Rule 5250 that says that an issuer is not allowed to pay a market participant directly for making a market in their product. I know this is not a regulatory panel or anything like that, but do you feel in your minds that's where this eventually will go after we get to, 8,000, 10,000, 12,000 ETFs listed, and the ETF market making community, either stagnates or kind of stays the same? And, from a standpoint of adding more bandwidth and adding more products, I think most of the market makers that are out there right now have the systems in place, and we can just add other products if they're pretty similar. But when you're talking about capital, you're talking about, being out there from 9:30 to 4, or from 4 a.m. to 4 to 24 hours a day. Do you feel that we'll ever get to that point where there is going to be a direct payment towards market makers?
Yeah, I'd say for asset managers in this room that aren't a part of STA, I would very much encourage you to become a part of STA and join the STA ETF committee, because that's where a lot of these groundbreaking conversations are happening. And that's where a lot of different industry participants are kind of talking through the complexities of that and why that may or may not be good for the ecosystem. On the SIBO side, we're constantly soliciting feedback from our clients on just, what do you think about this? How do you feel about this in general? Is this something that would work for you at the end of the day? And ultimately, from our conversations, there hasn't quite yet been an industry consensus on this topic. So until that further progresses and more ETFs come to market and maybe liquidity gets harder to source, we're looking forward to continuing those conversations. But at this point in time, there just has not been a clear consensus from our side on that issue.
Yeah, and I'll echo that. We are completely understanding the level of new launches and the constraints that puts on market makers. As you sort of mentioned earlier, there are really limited players in the space when it comes to being a designated market maker and being a lead market maker in a product. But from the conversations that we've had with issuers as well, we haven't really heard this desire to necessarily kind of echo that process that's happening in Europe. But we definitely are keeping an eye out on things. We're definitely thinking of ways that we can continue to further incentivize market makers, and overall how we can make the process easier for you guys, because we recognize the important role that we play, while also ensuring that our issuers feel comfortable with how everything is designed. And I think that the exchanges play a really important intermediary role currently, and I think that might be how the system continues to go, where we're kind of the in-between between the issuer and their listing fee, and then the market makers and their rebate and stipend.
Gotcha. Okay, along those long lines, let's switch gears here a little bit now and talk about innovation in the ETF industry and how the exchanges are positioning themselves to support these type of products and services going forward in the future. Like from your standpoint, AI was mentioned briefly before. Obviously, AI is much part of our lives. 5 years from now, it's going to be very difficult to probably see like what's real and what's not real, and kind of disseminating through that. From the exchange standpoint, for some market surveillance, for protecting investors, what type of AI are the exchanges currently putting into place to kind of scan for possible market manipulation? And then what do you think kind of where that goes to like the next level down the road? Gabby? Yeah,
AI is a really important part of our business overall. We've always at NASDAQ embraced emerging technologies, and that's part of the lifeblood, I think, of our exchange. When people think about us, they think about disruptive technologies. But from our perspective, we really think about it in two ways: AI in the product and AI on the business. So AI in the product are product enhancements that we make that are available to folks that they can really utilize that AI technology. So from our perspective, we actually have the first SEC approved AI exchange order type called Dynamic Mellow, which we launched a few years ago, and we've seen great success with that order type. We've seen continued increase in volumes, and we've seen a wide variety of market participants engaging in that product. From the AI on the business side, which is how we can implement AI within our own business to have greater efficiencies, unlock newer aspects to our businesses. What we're seeing, number one, is in market surveillance. We actually finished rolling out a pilot program for our market surveillance systems where we've seen enhanced efficiency. We've been able to see market surveillance analysts utilizing that AI to kind of finish their investigations quicker, do more investigations, and ensure that our markets are operating at the utmost integrity.
Yeah, thanks, Gabby. To build on that, as I mentioned earlier, we have automated surveillance tools in place that our trade desk utilize to scan for potentially erroneous or aberrant trades. But really where I see AI and where I see it developing is more so on the operational side. Obviously, we want to be careful how we deploy AI. We still like a high-touch human element as it relates to the listing process and bringing funds public. But there's absolutely use cases out there within our organizations that we could use AI to streamline the listing process and help funds come to market quicker and in a more efficient manner. So it's still early days. It's something we're monitoring, testing different applications around. But on a go-forward basis, I would only expect it to grow and firms to continue to utilize it.
Thank you. And from that standpoint, obviously, Jim Toes is here from STA. The STA had a heartburn for the last 4 or 5 years with our last SEC commissioner, with the different proposals that they were making for changing market structure. A lot of things that were, probably been pretty radical, not radical, but big changes to what people were experiencing for the last 20 years trading ETFs. Now with the new administration and the new SEC chair, now it's becoming, not how we're going to overregulate. It's kind of like how we're going to deregulate. And you've kind of heard from the other panels earlier today about triple levered ETFs being, filings for those, 5 times levered ETFs. So what is 5 times? So from that standpoint, how do you guys feel? From a regulatory standpoint, protecting the end investor, which is obviously everyone in this room's best interest, to also now be able to open up innovation and kind of being like, where do you think this is where's it going to stop? What kind of other products, or do you think 3X has a good chance of passing? 5X, obviously a little bit further out on the risk scale, but who knows, that could be approved also. Where do you feel from the exchanges standpoint, from your boardrooms, kind of with the new administration and new SEC, where do you see where things are going in the next 3 years?
Yeah, so we're in a different world today. Looking at 2025's launches, over 85% of them are actively managed products. Over 50% are incorporating derivatives in some sort of manner, whether they're swaps, futures, options, and over 30% have been leverage type products. We've seen so many different unique strategies come to market that's really democratized investment ideas for the retail trading community. With that, it's of the utmost importance that the exchange is on top of the products coming to market and continually speaking with the regulator and ensuring that the products that we're listing on behalf of our clients are, 1, meeting the exchange's listing standards, but 2, in the eyes of the regulator, are the products that they want to see come to market and are comfortable with coming to market. So we continually speak to not only our end clients, but the regulator, different ETF ecosystem participants to make sure they could support products. But that dialogue is very important, and it's part of bringing a holistic product to market.
Yeah, I think, number one, I think we're all a little bit happy to see the SEC reopening. As all of these new filings come in, it's really important for us to be in continuous conversation with them, because not only do we have our own rules to follow from the exchange perspective, but we want to make sure that we're always aligned with the regulator and our conversations are fluid and they have a full understanding of what's going on and we have a full understanding of the way that they're approaching new products so that we can support things in the best way possible. But additionally, I think it's pertinent for us to think about ways that we can innovate within the system and create clear rules for issuers to follow so that they know the kind of products that they can launch. I think in crypto, honestly, we are doing a better and better job in that as we think about innovative products there. We had the generics come out a little bit earlier this year in September, and we've seen a flurry of launches since then. And issuers are giving us feedback that now that they know which coins would be considered, which coins have this easier launch process, it's gotten to them to a much more comfortable point in kind of innovating around these new tokens because they're not having to kind of file a long haul filing that might take up to over 200 days and wait and hear back. And so I think just creating these transparent rule systems that allow issuers to plan around their products is the best way to go forward.
Interesting you mentioned tokenization, Gabby. That's obviously been a hot topic with crypto, tokenization of ETFs, ETPs on the exchange. And NASDAQ has had a filing that at our last ETF committee meeting in DC, it fielded the most questions of Zhang from NASDAQ was about tokenization. What does it mean? And Gabby, can you just kind of give like a quick overview of that filing? What are you trying to accomplish? And like kind of who's the target investor that you guys are looking at to kind of be able to provide this for them?
Yeah, absolutely. Really what we're trying to do with this filing is allow this new and innovative kind of technology to work within the systems that we already have established to create a really easy and simple process for folks who want to engage in tokenized assets to be able to do so. It really came from hearing from our issuers that they're interested in the space, especially from the corporate issuer side. I think there's a lot of questions around tokenization projects that have already happened. And really what our tokenization does is allow when a market participant is trading within our order book to either check tokenized or not tokenized, and then the asset will go through the regular NASDAQ order book, will go through the regular liquidity pools. We are, as I mentioned, the largest liquidity equity market in the world, and so they're able to utilize that liquidity there, and then in the clearing side, that's when you will get your tokenized asset, and then it will live in the wallet that you have set up for it. And so, like I said, really it's also about the not only liquidity, but investor protection there. You know what you're owning, you're able to trade it in a transparent market that you already trust, that already has clear regulatory rules, and it really just encourages kind of that next step in the crypto and tokenization process.
Gotcha. And Victor, are you guys envisioning any type of filing like that or anything in that realm?
You know, on the crypto side and blockchain side, holistically, it's still very early days, and there's still a lot of kinks to work out with different downstream service providers that would impact how we roll out that type of technology. So we're continuing to look at it, monitor it, but nothing in the near term that I would expect to see on the SIBO side there.
Gotcha. All right, so I have one more question, and then we'll open it up to some questions from the audience here. From your seats, where do you think? Do you guys think there's kind of like a black swan out there, or something that's kind of no one really is expecting to happen over the next 12 to 24 months that kind of radically change, the exchange ecosystem, kind of what's be able to list there, new entrants coming in, anything that you kind of can share with the crowd where you kind of feel like it could be something that no one's really thought of at this point, but obviously, you guys are thinking about that from your seats, kind of what can possibly happen and how do we adapt to that?
Yeah, I don't know about a black swan type event, but one thing that we're continuing to keep apprised of and developments on is just blockchain work holistically and how blockchain could play into the ETF world and impact the ETF world. So that's something we're working through with a few different working groups on our side and getting a better understanding of. But I hope there's no catastrophic event that impacts the exchanges on a go-forward basis, Steve.
I'm talking about a disaster like that. Yeah.
To your point, though, we do continue to see an increase in market complexities. There's new dynamics that are at play, it feels like almost every day when it comes to what's impacting the markets. And I think that's where ETFs really come in. We see that when there are large volatility events, investors are more likely to go into these sort of broad-based safe equities. And we see that consistently over time, such as the NASDAQ 100, such as the S&P 500. And so we think that regardless of sort of the market dynamics at play, the market environment, we're hopeful that investors will continue to look to ETFs as almost that fleet of safety, that safe space to buy and hold and get you through more complex market dynamics.
Gotcha. I'd like to, we have a couple of minutes left here, about a minute and a half left. Does anyone have any questions for the panel members?
Thanks. Steven, I actually have a question for you, not
Yeah.
the panelists. So we talked a lot about ETF launches, but there's also a lot of closures. As a market maker, are you handling liquidity and making the market on ETFs that don't have a lot of volume all the way through closure?
Yes. I mean, so the underlying principle of an ETF is that the liquidity of an ETF is based on what the underlying components are of the ETF. So you can have an ETF that's trading, 500 shares a day on the exchange, but its S&P 500 stocks are in the underlying basket. It'd be pretty easy to buy a large block of that ETF and utilize the create redeem process of an ETF of the ETF in order to buy the shares from the market maker. So we support them all. I think the other refreshing thing that's happened over the last few years, at least, issuers are not really stuck with keeping with a bad idea that hasn't gained any traction, and at some point, the ETF, they are delisting, and that does happen. But obviously the stats will say, and Victor and Gabrielle will say, there's definitely more new listings than closures. But I think the ability of ETF issuers of being like, hey, we're not going to keep throwing money at an idea that hasn't really caught on to the investing public, theoretically making it a commercially viable product, and then they're willing to close it down. And from our standpoint, we'd rather put our resources to a product that is trading. We understand our role as being an incubator of the product when it first starts out to make those tight markets, provide liquidity, so when the investor comes in and wants to buy the product, that they're getting a fair price and they're not paying for the load and the spread of the ETF that they were saving by not having to pay the high load of a traditional investment vehicle.
Hey, Steve. Just a question. Seems like there's a potential, car wreck happening in the sense that a lot of market structure has been focused this year on overnight trading and 24-hour trading. And even in this panel, we talked about avoiding the open and close. So I guess just more broadly for the exchange perspective, has the conversation shifted with regulators to establish ETFs as their own category? Or does that become lumped into equities and single name stocks, particularly that pulls that in? Pre and post has been available on both of your exchanges for a while. Does the exchange see a need to establish more of a dichotomy between the asset class of ETF as its own? And do you guys, is the data or the conversation supporting pushing ETFs into that overnight 24-hour conversation?
So essentially, are you more so getting at protections in the overnight and pre-market session around like limit up, limit down bands or more investor protection type initiatives during unprotected quote periods?
Is there a place for ETFs to create post-market if the liquidity providers aren't comfortable around the open and close? Why should I trade a block at 2 a.m.?
Yeah, well, what's really nice about that is when we look at some of the main liquidity providers out there, just like Old Mission, they have trade desks in London and they have trade desks across the globe. So for some of our newer launches or even our products on a go-forward basis, we're seeing in some of those high-volume names very robust markets in the pre-market session and post-market session. So as lead market makers look to kind of really quote different types of products and establish themselves across the globe, just like on the SIBO side, when we utilize a follow the sun model from a trade desk perspective, there's different market making units out there that utilize that same type of model so they could provide liquidity during all different times of the now new trading day, I should say.
I was just going to add that from our perspective, because we support both really large name corporate issuers and large ETF issuers and a variety of ETF issuers, we look at things very holistically. And so we're not planning to split anything up in particular. But I think there's ongoing conversations about ways to ensure that there is investor protection and ways to ensure that trading remains orderly and liquid throughout both the pre-market, post-market, and regular session.
Anyone else?
You guys have all talked about how with the increase in just the number of launches and funds, capital is becoming more of a challenge and more of scarcity, and you talked about incentivizations at the exchange. Is there a competition between you in terms of setting up that incentivization and trying to make it more attractive for a lead market maker to maybe not be as agnostic?
I
Putting
think
you on the spot.
I think generally, from our perspective, although the exchange competition world is fierce, we're not necessarily competitive over the market makers because we understand that each issuer might have their own preferences surrounding the market makers. We certainly want to design a program that best fits what the market makers are telling us and what the issuers are telling us and feedback overall. So really, I think it's about looking at the data, making sure that we're incentivizing around that data, and then getting feedback and then working off of that feedback.
From a quotation requirement perspective, we want to roll out the best program possible on the SIBO side. And how we develop that is conversations with market makers, conversations with asset managers, understanding what are your pain points from an ETF market quality perspective, and how can we put something in place to address that. When it comes to the compensation element of that program and the rebates that are in place, I would say there's absolutely competition to an extent because we want to incentivize market makers. We want to incentivize liquidity on our books. So it is a very unique space. We work with pretty much all the same lead market makers out there across the ETF universe, but the way in which we go about rolling out our programs and identifying our programs are really designed in a sense to make them cutting edge and extremely innovative, excuse me.
I think that's it. Thanks everybody for your attention, and I believe lunch is next.